On February 14th, 2019, the Coca-Cola Company reported fourth quarter and full year financial results for the period ending December 31st, 2018. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about Coca-Cola's business model. Coca-Cola was founded in 1886 and has grown to become the world's largest beverage company. Coca-Cola products are found in more than 200 countries worldwide, and it serves more than 2 billion beverages every day. The company has a current market capitalization of $200 billion, with annual revenues in excess of $31 billion. Coca-Cola is one of the world's most popular dividend growth stocks. The company's current yield is 3.4%. Moreover, Coca-Cola is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 57 consecutive years. This qualifies Coca-Cola to be a member of the Dividend Aristocrats Index, a group of exclusive dividend stocks with 25-plus years of consecutive dividend increases. In fact, Coca-Cola's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of consecutive dividend increases, Coca-Cola is a member of the Dividend Kings, an even more exclusive group of stocks with more than 50 years of consecutive dividend increases. Looking ahead, investors interested in owning Coca-Cola stock will want to know the safety of its current dividend payment. For the remainder of this video, we will discuss Coca-Cola's dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Coca-Cola's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2018, Coca-Cola generated earnings per share of 43 cents, which compared favorably to the 39 cents of earnings per share in the same period a year ago. For context, Coca-Cola currently paid a quarterly dividend of 39 cents per share during the most recent quarter, which implies a payout ratio of 91% in the most recent quarter. Looking out over a longer time horizon, the company's payout ratio is meaningfully lower. Coca-Cola generated $2.08 of earnings per share in fiscal 2018. The company distributed $1.56 of common share dividends during the same time period for a dividend payout ratio of 75% in the full fiscal year. Using earnings, Coca-Cola's dividend appears safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Coca-Cola's current dividend payment to its free cash flow. Coca-Cola generated $1.9 billion of cash flow from operating activities in the fourth quarter of fiscal 2018 and spent $430 million on capital expenditures during the same time period for free cash flow of approximately $1.51 billion. The company distributed $3.3 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 219%. Unlike most companies, Coca-Cola makes 2 dividend payments in the fourth quarter, which contributed to its high dividend payout ratio in this reporting period. Looking out over a longer time horizon, the company's payout ratio is lower. Coca-Cola generated $7.6 billion of cash flow from operating activities in fiscal 2018 and spent $1.3 billion on capital expenditures for free cash flow of $6.3 billion. The company distributed $6.6 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 105%. Using free cash flow results for the year, our conclusion for Coca-Cola's dividend safety is different from when we used earnings. The company's dividend is currently not well covered by free cash flow, and there could be a risk of a dividend cut in the near future. We recommend that investors monitor this trend closely moving forward. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Coca-Cola's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Coca-Cola's performance during this time period is shown here. Despite a slight decline in 2009, Coca-Cola's adjusted earnings per share increased 14% during the last recession. Coca-Cola made a new adjusted earnings per share high in 2010. More importantly, the company's earnings still covered its dividend payment, and Coca-Cola continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. Normally, we include an interest rate stress test in these analyses that shows how much Coca-Cola weighted average interest rate would need to increase before its dividend would no longer be covered by free cash flow. Unfortunately, Coca-Cola's dividend is already not covered by free cash flow, so we have excluded the stress test from this video. We reiterate that investors should monitor this trend closely moving forward. Thank you for watching today's video, which performed a deep dive on Coca-Cola's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.